A common misconception in Texas is that homeowners in Texas don't pay capital gains tax when they sell their property. Although that is partially true because in Texas we don't pay capital gains tax on our income, it's not entirely true because Uncle Sam still wants his capital gains tax. And in this video, we're going to be diving a little bit deeper on capital gains tax in Texas for all Texas homeowners. What can you expect? Whether you are a homeowner yourself or you're an investor, we're going to cover several things like short-term and long-term capital gains, exemptions that you might qualify for, and if you're an investor, how can you defer those taxes further down the road? Okay, so let's get everybody on the same page. How is capital gains calculated in Texas? Let's get into the formula. We're going to look at the sales price of your home, and we're going to subtract the original cost, what you paid for it, both in fees and also the property price itself, any eligible improvements in the property, and then we're going to have any costs in selling the home. That is ultimately the leftover amount. That is the amount that can be taxed or capital gains. The good news, if it is your primary residence and you have lived in that primary residence for 2 of the last 5 years, you may be eligible to be completely tax exempt on that money and not have to pay any capital gains tax on any of the gains that you made on the sale of that property. It doesn't even matter if you don't move that money into buying another property, those monies are yours to keep. Now there are 2 different types of capital gains taxes. One is short-term capital gains and the other is long-term capital gains. Very simply explained, if you've owned the property for less than 12 months, then you would be applying short-term capital gains. And in that case, if you did make any money on that property, you'd be basically taxed at your income tax bracket. No deduction in taxes, etc. If you own that property for more than 12 months, then you'd be paying long-term capital gains. Long-term capital gains are typically between 15 to 20%, maybe a little bit lower than what you're paying in your income tax bracket. It really based on how you file and ultimately how much money you make. You got to talk to your tax guy to figure that out. The sweet thing is that real estate gives some pretty good benefits on gains because you don't quite pay as much, especially if you hold the property longer term. Now, if you are an investor and you're going to be selling your home, getting that top dollar, you got to remember that you do have depreciation recapture. Now, keep in mind, as you've owned this rental property for a while, you've been doing something pretty sweet called depreciation, ultimately breaking down the amount of money you have to pay in income taxes on that rental property that you've been receiving over time, right? So real quick, the government has this cool option for you if you're a rental property investor. You can take the purchase price that you buy your home for, subtract the land value, and you divide that value by 27.5, and this gives you the number that you can deduct from your rent income on your taxes every single year. So this is a pretty cool break. It gives investors an opportunity to ultimately keep more of that cash in their pockets and invest more of that maybe in other things. Could be other rental properties, etc., right? But when you sell, you will have some capital gains on the money. So we're going to explain how that works. So let's take a fake property and let's just say 100K home, okay? And a land value of 20K, right? We're going to divide that by 27.5. So this gives us a value of 2909 that we can deduct from the rent that we're making on that property every single year. That's pretty awesome. And after owning that property for 5 years, we get a total depreciation of $14,545 that we are ultimately depreciating over this time, right? So basically you made that money in rental income, but you didn't have to pay income tax on that rental income when you made it. However, when you sell, you do pay taxes on that money. So how does that work, right? Are they gonna get you back worse later if you do this and so forth? Not necessarily. So we'll explain an example here on a sale, how they would look at that. Same property. Let's just say, going back to capital gains, the sale price, let's just say they sell this house at $120,000. And we're going to subtract this, right? We have the original purchase price, 100K, and we're going to subtract the 545. So remember, you're going to do the part in parentheses first, and then subtract it from 120, and you get 34,545. So basically, it's as if those were profits as well in the sale of the property. It's a little bit different than maybe a traditional capital gains that was for a primary residence, right? Because now we've depreciated that value and we now have to pay the income tax on that. You're not paying the full 14,000, you're just paying income tax on the amount that you made, that 14,000. So now you have a value of 34,544, or 45, I apologize. And this will be multiplied by that long-term capital gains tax in this case, because we had it for more than 5 years. So it might be by 15% as an example. You need to talk to your tax guy to figure out what your percentage is. But that is how the taxes are calculated for an investment property when they're sold. Now, you might be asking, is there any way out of paying those taxes? And the answer to that is no. Only thing in life that is certain is death and taxes, that's for sure. Now, you can defer or delay the time it takes to pay those taxes through a vehicle called a 1031 exchange. In a 1031 exchange, you're essentially swapping one rental property for another rental property of like kind. And there's a bunch of little rules into that, but explaining it at a high level, I sell my rental property at the title company here in Texas, and then those funds, they never hit my bank account. They're not allowed to touch my bank account. So they have to go to a qualified intermediary there that can receive those funds for me. And there's a set of rules that I have in order to get that money and be able to use that money on a purchase of another property. The beautiful thing about that, of course, is the fact that I can use more of my dollars that I've earned in that property in purchase of a potentially bigger property and have that bigger property appreciate even faster or longer over time, helping me get to my retirement goal or my financial freedom goal that I might have. Okay, with that being said, there are really two timelines that you need to be aware of. One, you have 45 days from the day of sale of your home where you can find another property and identify a property that you will purchase. That means I can identify up to 3 properties, 3 different houses that I want to buy. I don't have to buy all 3, I just have to identify all 3 before the end of that 45-day period. I might be making offers on all of those and I might back out of 1 or 2 of those, so on and so forth. But I have that time frame to get there. The second time frame you need to be aware of is 180 days, again, from the day of sale. It's not that you go through the 45 and then 180 days. No. 180 days is from the beginning of that sale. You need to be able to close and purchase a house with the funds that are in your 1031 account held by that other party and close on those properties, right? Now, a few things. The properties must be of greater value than the property you sold, but it could be 2 properties that combined have a greater value than the property you sold. So it's a great way to sell a property, either buy multiple properties or get into a multifamily property and have a larger unit that is appreciating over time. If you do want to go through with a 1031 exchange, reach out to us. We've done them ourselves on our own rental properties, and we've helped our clients walk through these transactions as well. We can get you connected with the right people and make sure that you follow each of those steps in order to make the deadlines you need to make and qualify for that 1031 exchange. And that's a wrap for capital gains in Texas. We'll see you at the closing table.